Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Charlie Huggins, manager of the new Wealth Club discretionary share portfolio. I first met Charlie 12 years ago when I was a director at the asset management firm Hargreaves Lansdown. Charlie had been buying shares since his teens, and after graduating from Oxford with a first in biochemistry, he really wanted to join a graduate trainee programme to become a fund manager. The trouble was, Hargreaves Lansdown didn't offer one at the time. However, I was so impressed by him that I actually created a graduate trainee programme specifically for him. Sure enough, he did end up running a £300 million fund, HL Select UK Growth Shares, and the fund generated a total return of 64.7% during his 5-year tenure versus 38.7% for the peer group, ranking at 26 out of 209 funds in the sector. Hello, Charlie.
Hello.
Firstly then, tell me how you got into investing.
So I bought my first share age 16 or 17. I think they were Standard Life shares, bought them from my mum because she was a policyholder at the time. Went to university in 2007 and decided to invest a large portion of my student loan into the UK stock market at that time. Then, of course, we had the financial crash in 08-09, so lost a little bit of money around that time. That was quite an interesting experience and quite a humbling experience. But I think actually that has shaped my investment approach. I think those early experiences do often shape an investor. So it's probably instilled a sense of caution in me that's probably never left me. And then, as you said, joined Hargreaves Lansdown in 2011, straight from university on a graduate programme, which you were obviously running at that time. And quickly moved on into the investment research department, helped set up Hargreaves Lansdown's equity management capabilities, and then launched the Select funds and run those for 5 years before joining Wealth Club in April 2022.
So Charlie, tell me about the discretionary share portfolio that you're launching.
So the discretionary portfolio will hold 15 to 20 companies. It will invest in the highest quality businesses I can find. The shares will be held in nominee form on behalf of the client, and the client will see every share that I invest into. And there will be regular communication with investors, so we'll be sending out regular articles, emails, blogs, videos. So clients will be informed every step of the way.
What's your investment approach?
My investment approach really is to own great businesses, the best businesses I can find with superior cultures. I'd say there's probably one or two things that differentiate my approach. I am very long-term. I think a lot of the industry isn't overly long-term. I think they're focused on what's going to happen next quarter, or what this year's profits will be for a company. I'm looking out 5-10 years into the future to try and find those businesses that can deliver strong growth in profit and cash flow over a 5 to 10 year period. I'm very focused on the management and culture of an organisation. I think that has a huge impact on investor returns over the long run. Ultimately, the culture of business dictates the decisions that a business makes. And if you get the culture right, that can be enormously powerful and is something that is often overlooked by many. And third thing, very risk aware, probably more focus on downside, more interested in how much I could lose than how much I could make. So I have a 60-point investment checklist, which I run every company through, that appraises various risks, regulatory risks, economic sensitivity, customer concentration, moat, management, culture. It doesn't matter how good the growth prospects are or how great the story is. If a business fails too many of those risk filters, I won't invest. So I'd say they're the main things. Common sense and simplicity as well. I'm not trying to do anything too complicated or esoteric with this. Keep it relatively simple and straightforward.
Okay, and you're looking for great businesses. How would you define a great business? What does it look like?
Well, a great business is a combination for me of a great business model and a great culture. So these are businesses often that are doing something quite special and quite unique that many other businesses aren't, and that you can't really go many other places to get what that business provides. I think a great business needs to have a strong competitive moat around it. It needs to have that barrier to competition, because it doesn't matter how strongly the market or the industry is growing. If the business doesn't have strong competitive advantages, then it's no good. It's just going to, it's going to be destroyed by competition. So that can come in the form of brands, distribution networks, network effects, for example. I think a great business also should have great resilience. The economy can go up and down. It's obviously a bit of a tough time at the moment. And you need businesses that can emerge from a crisis stronger and are prepared for a crisis. And a highly resilient business can do that and should have longevity as well. So businesses that are highly resilient, and as I said, with those cultures and managements that can, constantly widening that economic moat every day. So to me, that's what a great business is.
Very interesting. And how will this share portfolio differ from what you were doing at Hargreaves Lansdown?
It's a similar approach to what I was doing at Hargreaves Lansdown. So I'm not trying to do anything wildly different with this. That said, there will be one or two differences. So this portfolio will be even more concentrated, so 15 to 20 names. At Hargreaves Lansdown, I was typically owning about 25 to 30 stocks. That may not sound like a huge difference, but it just means that I can really focus down on the best opportunities and my highest conviction ideas. I'm not having to pad the portfolio out with lower conviction or lower quality names. In addition to that, I'll have total freedom with this portfolio. It's a go anywhere portfolio. In my previous fund at Hargreaves Lansdown, I could invest up to 20% overseas, and I did use that flexibility. But with this portfolio, I can invest as much as I want overseas. It's going to be developed markets, UK, Europe, and the US, companies of any size. And in addition, in my previous role, I was running almost £500 million. At times, it was quite hard to trade in and out of smaller companies. I don't expect liquidity to be an issue with this portfolio, so shouldn't really be any liquidity constraints.
And can you talk to us about some of the companies you like? Give us a few examples.
I've talked about this company quite a lot. I've done a podcast on it, but one would be Diploma, which is a specialist industrial distributor listed in the UK. It's a value-add distributor, so it's got that competitive moat that I look for. It's not just a commoditized distributor. It distributes things like seals, which go into industrial machinery, life sciences products, which go into hospital laboratories and hospital and the surgical setting. High margins, very strong cash flow, and very good growth prospects. This is a business that has generated spectacular returns for shareholders over the last 10, 15 years. It's got very good organic growth prospects. Probably most importantly with Diploma, it layers on a superb acquisition capability. So it typically pays a single-digit operating profit multiple for businesses. It acquires them, it brings them on board, and it's just done that really successfully over a long period of time. And I expect that acquisition capability can continue to drive the business over the next 5 to 10 years. Added to that, it's got a highly entrepreneurial, decentralized culture. You shouldn't think of Diploma as being a single business. It's many smaller businesses all in one, each with their own chief executive, each in charge of their own profit and loss account. And that comes back to what I was saying on culture, entrepreneurial, and that's been a major driving force behind that business. Another business I like is Croda International. It's a specialty chemicals company. Its chemicals go into things like personal care products, so skin creams, and they confer specific properties. So if you buy a skin cream, or your wife probably buys a skin cream that says softer skin, Croda's chemicals will be crucial to conferring that effect, so absolutely critical. Its chemicals also go into healthcare delivery systems, so they are used to target drugs to a specific place in the body. And it was actually used on the COVID-19 Pfizer vaccine, Croda's chemicals. That was obviously wildly successful and has opened up an enormous array of other therapeutic opportunities for Croda based on mRNA technology. So I expect over the next 5 to 10 years, Croda's chemicals will be used on many more drug platforms in the future, which will really drive it. Great barriers to entry, high pricing power, often patent protected products, often specified on regulatory documents of drugs, so which makes switching away to a competitor very difficult. That all lends itself to enormous pricing power and means the business can easily pass on higher costs, which is obviously very important in an inflationary environment.
So those are companies you like. What about the types of companies you'll avoid?
It's the vast majority of businesses that I'll avoid. There's probably over 10,000 listed businesses, of which probably less than 100 would be of interest to me, and of those, 15 to 20 will make it into the portfolio. Main reasons I would avoid a business would be simply lack of understanding. There's lots of fairly complex, esoteric, special situations out there which I'm just not going to go near. So that comes back to keeping things simple. If a business doesn't have a competitive advantage, I'm not going to go near it. If it doesn't have a good culture, I'm not going to. Things like commodities and oil-based businesses, oil companies are doing well at the moment, but that's all predicated on the oil price staying high, and that's something they don't have any control over. So, in order for me to invest in a business, it has to be in charge of its own destiny. I think that's really important.
And the trouble with a lot of good businesses is that they are quite expensive. So how do you avoid overpaying?
That's a really good question. One thing I would say is that's always at the very end of my investment process. So what I don't do is say, right, let's find some really cheap businesses. That can lead to often owning lower quality businesses. That's something I just want to avoid like the plague. I'm happy to pay up for a business. I will pay up for a business, but I need to make sure that business is exceptional. I will look very carefully at how much cash a business generates. People tend to rely too much, I think, on things like price earnings ratios. Profit and cash aren't the same thing. You need to follow the cash. So I look at the free cash flow that a business generates and compare it to what price it's trading at, and then make an assessment. It's a much more an art than a science valuing businesses. What I won't do is go near any of these companies that we've seen recently that have traded at exorbitant valuations and that aren't really generating any cash and that don't have very good business models. If it's got a superb business model, a superb culture, I will pay up within reason for that business, but I'm not going to go paying stupid multiples.
And is now a good time to invest?
Obviously it's a difficult time at the moment with inflation at really high levels and interest rates going up, and that's a difficult backdrop for consumers and for businesses. One thing I would say is that in a difficult environment, the strong often get stronger. Strong businesses often get stronger, and they're exactly the sort of businesses that I'm looking for. In a recession, all these zombie companies that have existed through low interest rates over the last 10 years could potentially be wiped out over the next few years as interest rates increase. And for a strong, dominant business, that's actually often a blessing. In the short term, things may well be difficult, but if you find those great businesses, then in the long run, you can make good money. And the other thing I would say is don't bet against the global economy. Yes, things look a bit difficult at the moment. I'm not too bothered about the next year or two. It's what's going to happen the next 5, 10, 20 years. And it takes a brave person to bet against global economic progress over that time.
I'm investing in the portfolio. You are too, yes?
Yes, I will be investing a substantial portion of my own wealth in this portfolio. My wife will also. You will, obviously. Friends and family will be investing as well. So I think this aligns my incentives very well with investors. This is one of the reasons we want to set this portfolio up, was because, to give investors a vehicle to invest alongside us. So this isn't an us and them type thing. This is we're all in it together.
So what's the rationale behind such a small number of companies?
I think 15 to 20 gives you plenty of diversification. There are a number of studies that suggest that beyond that, there's not much diversification benefit gained anyway. The advantage of keeping it concentrated is frankly not having to dilute the portfolio with lower quality ideas, meaning that I only focus on my best ideas. Every idea makes a difference. And frankly, just keeping track, of a portfolio and of the watch list will be easier with a smaller number of names. So there's only a limited amount of time in the day. I have to really focus down on the businesses I'm most confident in.
And how much will you hold in each company?
It will be equal weightings in each when you first invest into the portfolio. Obviously, as different companies perform differently, that will change, but I will rebalance every 6 to 12 months. You could view that as a bit of a cop-out, actually, and say, well, why aren't you owning big weightings in some that you're more confident in or whatever? And lots of fund managers do that. I'm just not convinced that actually adds much value. It's very difficult to say in advance where the performance in a portfolio is going to come from. And frankly, if I don't have conviction in a name, I just won't hold it at all. I'm not going to hold it at low weight. I just won't own it.
Trading, you going to trade often?
Lethargy bordering on sloth. I'm not an active trader. I look to own great businesses for the long term, for 5 to 10 years. If you've got a great business, if it's performing well, the best thing you can do is leave it alone. Don't interrupt compounding unnecessarily. It will be rebalanced every 6 or 12 months. That will incur, some trading, mechanical trading. But the trading fees will be kept very low. And of course, sometimes I will sell a business if I make a mistake, which hopefully will be not that common. If the valuation gets to too high a level, I may sell it, or if a new opportunity comes up, because I'm not going to go beyond 20, so this will be a one in, one out portfolio. But it's not going to be actively traded very often.
You're always talking about culture in a company. Why is that so important?
Culture, it dictates how decisions within a business are made, and that is absolutely critical. You look at the success of businesses like Amazon and Google and all of these businesses. Culture has been the big aspect that has driven that. You look at most large businesses, and frankly, the cultures are not great. They're highly bureaucratic. They take an age to make decisions. They're full of process and policy procedure. They don't spend money like it's their own, and they don't think differently, and they think short term. And that's the culture that defines a lot of businesses out there, which frankly I'm not interested in. It's those businesses that almost think the opposite way to that, that think long term, that think differently, that excel at capital allocation. They're the businesses I'm interested in. And that all comes back to management and culture.
So how do you assess culture?
You can get a very good idea about the culture of a firm just by reading the results and the annual reports. If you read Berkshire Hathaway's annual report, for example, you can see that Warren Buffett and Charlie Munger, who run the Berkshire Hathaway investment partnership, they clearly understand capital allocation, they're clearly honest, they clearly admit mistakes, they clearly value integrity. And you can see that they think very long term and they think differently. So that's an example where you can see it on paper. Of course, just saying it is not necessarily the same as also doing it. So then you need to see, does the company's words and messages align with the actions that they're taking? With Berkshire Hathaway, you can see that the accounting is very clean. They've generated lots of cash. They've done so for many decades. So the messaging is very consistent with the actions. I also draw on customer reviews, employee reviews. I speak to ex-employees sometimes. That can give you a good insight into the culture of a business as well.
What's your typical day look like as a fund manager?
Typical day, every single day for me starts with reading company results. So in the UK, the results are released at 7 a.m. every morning. And every single day, pretty much without fail, for the last 10 years, I've read those company results. It doesn't matter whether I'm on holiday, doesn't matter whether I'm on honeymoon, doesn't matter whether I'm getting married that day, I'll read the company results. That can last a couple of hours. It could last all day, depending on how many results have been released. Then I may spend the rest of the day reading annual reports or catching up with webcasts, or maybe reading a research paper into a particular industry. But what I would say is my day is not in any way glamorous. It's a lot of sitting, it's a lot of reading, it's a lot of thinking. I don't spend any time looking at share prices, looking at Bloomberg, watching CNBC or anything of that nature, just sitting, reading and thinking. So often my wife says to me at the end of the day, what did you do today? And I said, well, absolutely nothing. Most days I'm not, if you look at what I'm actually doing on a day-to-day basis, it's very limited, but I am spending a lot of time sitting, reading and thinking.
What are your views on the fund management industry as a whole?
I think there are some exceptional fund managers out there, and I invest in a couple myself. But in general, I'm not a big fan of the fund management industry and how fund managers think. In fact, I hate being described as a fund manager because I just, I don't like the short-termism that tends to characterize the industry. Most fund managers are only interested in, what's this quarter's performance going to be like? What's next quarter? What are this year's numbers going to be like for this business? Very short-term. They are in the main, very interested in career risk and very driven by career risk, which means, again, short-term decisions. They all tend to often herd into the same areas. And they're all consuming the same information. It's often analyst reports, which again are very short term and very full of noise. Many fund managers also run very excessively diversified portfolios of 50 or 100 stocks, which to me makes no sense whatsoever. And a lot of funds are, in my view, just closet trackers. So one thing I can tell you with this portfolio is that I will think differently to most fund managers, and I'm certainly not going to run a closet tracker. You will get a genuinely highly concentrated, high conviction approach.
And to summarise, Charlie, why should people invest with you?
Hopefully I am offering something a little bit different to what's out there. I believe in this hugely. You believe in this hugely. I'm in an environment of Wealth Club that suits me down to the ground. It's a great business. It's a highly entrepreneurial business. It's got great people working for it. It's a joy to come in every day and work in a business like that, and to be trusted to do a job, and to have that autonomy to do the job to the best of my ability. So all the tools are there for me to perform. And I'm absolutely purely focused on this one portfolio to make it work. So I will try my very best to do so. Obviously, I can't guarantee anything. I think investors do need a long-term horizon. They need to share my long-term 5 to 10 year horizon. But if they can do that, and if they can be patient, then hopefully they'll be rewarded.
Charlie, thanks very much.
Thank you.